Welcome back to the Deep Dive. It is January 30th, 2026. And, if you've been looking at your portfolio this month, or just scrolling through the headlines and felt, I don't know, a bit of vertigo,
yeah.
I just want you to know you are definitely not alone. It has been a dizzying, almost schizophrenic start to the year.
Schizophrenic is the right word. I think contradictory might be too polite for what we're seeing.
It really is. I mean, just look at the signals we're trying to parse here. On one hand, you have silver going absolutely vertical.
Just, rocket ships.
Literal rocket launches.
Right.
And on the other, a titan like United Healthcare, basically falling off a cliff and dragging the whole Dow Jones down.
And then when you zoom out to the macro picture, it gets even more confusing. You've got these valuation metrics that are just screaming bubble at historical levels.
Right.
But then the VIX, the so-called fear gauge, is just calm, totally zen, like nothing's wrong.
It's like the market is screaming and whispering at the same time. So that's our mission for this deep dive. We're going to try and make sense of this market where these huge valuations are just colliding with these very specific, very violent sector shocks.
It's a paradox. And to untangle it, we've pulled together a pretty serious stack of sources. We're looking at Steve Eisman's latest weekly wrap. And if you know Eisman from The Big Short, you know he doesn't pull his punches.
Not at all.
And we're crossing that with a sort of Druckenmiller-style macro dashboard to see what the raw data is telling us versus the story.
The micro and the macro colliding. Now, before we really get into the weeds of, silver shortages and AI, I have to mention a tool that was honestly super helpful for us prepping for this. When valuations get this crazy, you need to keep your eye on the big picture. We found this iOS app on the Apple App Store. It's called Buffett Indicator.
Oh, yeah, the one that tracks the total market temperature. It's based on Warren Buffett's favorite metric.
Exactly. It's like a simple reality check right there in your pocket. If you want to see just how overheated things are at any moment, seriously, just search Buffett Indicator and download it. It's a game changer for keeping context when the headlines are just noise.
It helps you visualize the risk, which is, half the battle.
Right. So here's the plan for today. We're going to unpack the China-led panic in silver, the whole K-shaped struggle for the average consumer, the regulatory bomb that just dropped on health insurers, and then, this is a fascinating one, a huge rotation in the AI trade, from software to power plants.
Now, literally, to the physical stuff of AI, the things you can actually go out and kick.
Okay, let's start with that big picture then. We have this macro dashboard in front of us. Just be honest, are we in a bubble?
Well, if you look at what we call the slow indicators, the ones that measure the market's sort of gravitational pull, the answer is yeah. We are very, very high up.
Okay.
The Buffett Indicator, which we just talked about, which measures the U.S. total market cap against GDP, it's currently sitting at about 224%.
224%. And just for context, where are we normally?
Historically, much, much lower. I mean, even at the peak of the dot-com bubble, we were lower than this. 224% is rare air. It's basically saying the stock market is valued at more than double the entire economic output of the U.S.
Wow.
And if you cross-reference that with the Shiller KP ratio,
The cyclically adjusted PE.
right, the one that smooths out earnings over 10 years to get a clearer picture, it's at 40.94.
Almost 41. That sounds extreme.
It is extreme. These numbers are screaming that future returns, say over the next decade, are probably going to be pretty thin. You're just paying a very high price for every dollar of earnings.
So gravity is definitely working against us here.
In the long term, yes. Think of these as gravity indicators. They don't tell you the market's going to crash tomorrow or next week. They're not timing tools.
Sure.
But what they imply is that the market is fragile. It's like walking on a tightrope. You just don't have much margin for error. If a shock hits, a geopolitical event, a sudden spike in inflation, the fall is a lot further.
But here's that paradox I was talking about. Despite those terrifying numbers, it doesn't feel like a panic out there. Traders seem pretty chill. The sky isn't falling.
That's the disconnect. The slow signals say danger, but the fast twitch signals, the ones that react instantly, are still very much risk on. Just look at credit spreads.
Explain that for a second. Why are credit spreads so important?
Sure. A credit spread is just the difference in yield between a safe government bond and a corporate bond. If investors are scared that companies might go bankrupt, they demand a higher interest rate to lend to them, so that spread gets wider.
Okay.
Right now, spreads for both high yield, what we used to call junk bonds, and investment grade are incredibly tight.
So lenders aren't really charging a premium for risk.
Exactly. They're not worried about companies going bust. They're just chasing yield.
And the VIX?
The VIX is sitting around 16.88. That's not a panic level. It's actually pretty calm. And financial conditions, according to the Chicago Fed, are looser than average.
So let me just get this straight. The market is historically expensive, super fragile based on valuations. but it's also swimming in liquidity and feeling pretty good about itself.
Precisely. It's a classic late cycle market. It's expensive, but it's being supported by liquidity and just sheer momentum, and it works, right up until the moment it doesn't.
Okay, so that's the big picture. Now I want to zoom in because there are some specific sectors that are either blowing up or melting down. But first, we've got to do the quick bit of housekeeping.
Always important to keep the legal team happy.
Absolutely. Just a quick reminder for everyone. Full deep value research reports can be found in the description links. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. So please, conduct your own due diligence before making any investment decisions. And if you want to listen to our full deep dive on this or get access to more advanced content, you're welcome to join the Deep Value Club membership or subscribe to us on devalues.ai.
All right, housekeeping is done. Let's talk about the wildest mover of the month.
Silver. I honestly had to double check these numbers. I thought it was a typo. We saw silver go from what, $72 an ounce at the end of 2025 to around $115 an ounce in January?
Yeah.
That's a 60% jump in 1 month.
It is incredible volatility. For a major commodity, that is almost unheard of. That is like crypto-level volatility in a precious metal.
So what sparked this? Is this just Reddit traders trying to meme stock silver again?
No, this is different. This is structural. As Eisman points out in his notes, this isn't speculation. It's a genuine supply shock. On January 1st, the Chinese government reclassified silver.
Reclassified it?
How? They moved it into the strategic material category. So think about how they treat rare earth minerals, things that are vital for national security, for tech, for solar panels. They just put silver in that exact same bucket.
Oh, wow. So you can't just load it on a boat and ship it out anymore.
Exactly. To export silver from China now, you need special licenses, strict quotas. It's this massive bureaucratic wall that just appeared overnight. And you have to remember, China controls about 60% of global refined silver.
That is a massive bottleneck.
Yeah.
If 60% of the supply just gets locked up behind a license, the price has to move.
It has to. And it triggered something that's a bit technical, but really fascinating. It's called backwardation.
Okay, let's unpack that. Backwardation sounds painful.
It's the surest sign of panic in a physical market. Normally in commodities, the future price is higher than the spot price, right? If you want silver delivered in 6 months, you pay a bit more for storage, insurance, interest. That's a normal market. It's called contango.
Right, because holding stuff costs money. Makes sense.
Exactly. But right now, silver is in backwardation. The spot price, the price to get the metal in your hand right now, is significantly higher than the future price.
So people are so desperate to get the physical metal today that they are paying a huge premium just to skip the line.
Yes. It just reveals a total lack of trust in the future supply. They're basically saying, I don't care what the price is in 6 months, I need it today because it might not even be there then.
Wow.
And there's a leverage problem here too. There's this huge disconnect between paper silver, the futures contracts people trade, and the actual physical metal in vaults. Estimates suggest there are something like 200 paper contracts for every 1 ounce of physical silver.
Wait. 200 to 1?
Roughly.
That just sounds incredibly dangerous.
Well, it works fine when everyone's just trading paper. Usually traders just roll the contracts over. They don't actually want 5,000 ounces of silver showing up at their apartment.
Right.
They just want the profit. But with this Chinese export ban, traders are panicking. They're demanding physical delivery because they're afraid the metal won't be accessible later.
And if 200 people show up with a claim ticket for the same single bar of silver,
you get a squeeze, a massive one. That rush for physical delivery is what's breaking the market's mechanics.
that is terrifying. Okay, so commodities are flying. But if we look at the other end of the spectrum, the average person, the consumer, it feels like a completely different world.
Oh, completely.
Yeah.
This is the definition of that K-shaped economy we keep hearing about. The top of the K, assets, commodities, things you own, it's going up. The bottom leg, the consumer, the wage earner, is heading down.
And we saw this so clearly with the earnings from Procter & Gamble and McCormick, right? I mean, these aren't luxury brands. This is toothpaste and soap and spices.
Right, consumer staples, the stuff you're supposed to buy no matter what. And the numbers were stark. Procter & Gamble showed 0 organic sales growth. Volume actually fell 1%.
So people are buying less soap or just cheaper soap.
They're rationing. They're trading down to store brands. They're using that tube of toothpaste until it's absolutely flat. McCormick missed earnings entirely. And think about that. McCormick sells spices. When people stop buying spices, you know budgets are getting incredibly tight. Inflation has really just worn people down.
But here's the psychological twist I found fascinating in the research. Even though the consumer is struggling to buy groceries, the retail investor, who is often the same person, is acting unbelievably aggressive in the stock market.
It's a fascinating contradiction. Eisman noted this specifically. On days when the market dips, the institutional investors, the smart money they're selling, taking chips off the table.
And retail.
They're aggressively buying
Buying the dip.
It has become a reflex. Retail investors have been, acculturated to buy every single dip because for the last few years, it's always worked. Every wobble has been followed by a roar back.
It's just muscle memory at this point. It's Pavlovian.
It is. And the expert view is that nothing short of an actual recession, not just the fear of one, but the reality of job losses, is going to break that habit. Until then, retail money is basically propping up these valuations while the institutions are quietly heading for the exits.
That puts the retail investor in such a precarious position.
Yeah.
They're the ones left holding the bag if the music stops.
Correct. They are providing the liquidity for the pros to get out.
Speaking of the music stopping, let's talk about the record scratch that happened with United Healthcare. UNH stock dropped 20% in a single day. For a company that size, a blue chip, that's a massive, massive move. What happened?
This was a regulatory bombshell. It all came down to the Trump administration releasing their pricing for Medicare Advantage for the year 2027.
And usually this is just kind of boring routine stuff. The market was expecting a bit of a bump, right?
Yeah, the market was pricing in around a 5% increase, to cover medical inflation, rising costs, the usual stuff.
And the actual number came in at
0.09%.
0.09.
Right.
That's basically flat.
In real terms, when you adjust for inflation, it's a massive cut. They're being asked to do more with significantly less real money. And for a company like United Healthcare, which is already struggling with rising medical costs,
Right.
This is devastating. Their margins at Optum Health, which was supposed to be this huge growth engine, they've been obliterated.
Eisman used a great analogy in the report. He said a company can be a fixer-upper with a leaky roof, an easy fix. But UNH isn't that.
No. He said UNH is a house with foundation problems that needs to be stripped down to the studs. This isn't a one-quarter miss. This is a fundamental change in how they make money. The government just turned off the tap.
And because UNH is such a huge stock, it single-handedly dragged down the Dow Jones. I saw days where the S&P and the NASDAQ were up, but the Dow was red just because of this one company.
It's a quirk of how the Dow is weighted, yeah. But it also just shows you how sector-specific the risks are right now. You can't just buy the market and think you're safe from these landmines.
Which brings us to the sector everyone thinks is the ultimate safety net, AI. But even there, the narrative is shifting. It's not just buy software anymore.
No, the trade is evolving very, very quickly. We're seeing a huge move from software to power.
To power plants.
Literally. The bottleneck for AI right now isn't code, it's electricity. These data centers are just incredibly power hungry. You can't run these massive models without massive amounts of energy.
So who wins in that kind of scenario?
Well, look at GE Vernova. They make the gas turbines that power these plants. Their orders are up 65% year over year. The stock has gone from around $130 to $700.
130 to 700. That is a rocket ship.
And look at a company like Amphenol. They make connectors, sensors. It sounds boring. It's the plumbing of the internet. But their earnings have been turbocharged by AI CapEx. They posted 77% EPS growth.
It's the old picks and shovels play, or I guess in this case, turbines and wires. This ties into Meta too, doesn't it? They announced they're spending, between $115 and $135 billion on CapEx?
An astronomical amount of money. I mean, that's the GDP of a small country.
It is, and normally the market hates that kind of spending. But because their revenue guidance was so strong, over $53 billion, the narrative just flipped. Investors said, okay, this isn't waste. This is a necessary investment.
So if you're building the physical infrastructure, the market loves you. But if you're a software company...
That is where the fear is creeping in. Look at ServiceNow, iconic software company. They beat earnings, they beat revenue, great numbers.
And the stock?
Dropped 10%.
Ouch. Why punish a beat?
The fear is that AI lowers the moat. If AI can write code and build applications instantly, do you really need a massive, expensive contract with ServiceNow? Investors are starting to worry that AI is going to eat software's lunch.
That is a huge shift. Software eats the world was the slogan for a decade. Now it's AI eats software. What about Microsoft? They're sort of the king of AI.
They are, but there's a specific risk there that people aren't talking about enough. Microsoft has this massive backlog of future revenue, $625 billion. Looks great. But 45% of that is tied to OpenAI.
Wait, nearly half their backlog depends on OpenAI.
Yeah, and that raises a really important question. Can OpenAI actually hit the financial goals required to pay that back? If OpenAI stumbles, Microsoft suddenly has a $250 billion hole in its backlog.
That's a staggering concentration of risk. Let's just quickly touch on a couple of others. Autos, Tesla.
Tesla is. Well, it's trading in its own universe. Revenue was down. The auto segment fell 11%. A bad quarter by normal metrics. But the stock is up.
Because of the robo-taxi story?
Exactly. It's trading at 200 times its 2026 earnings, based entirely on the promise of robo-taxis in dozens of cities by the end of the year.
It's a bold promise. If they pull it off, great. If not, 200x is a long way to fall.
Meanwhile, Apple is just quietly crushing it. iPhone 17 drove a 23% revenue surge. And surprisingly, they bounced back hard in China's sales that were up 38%.
So the Apple's dead in China story was maybe a little premature.
Just a bit. Never count them out. And finally, banking. New administration, new rules.
We're seeing a distinct move toward deregulation. The expectation is that regulators will allow banks to take on more leverage, maybe move from 14.1 up to 16 or 17.1.
Where leverage means more profit, but also more risk.
Correct. And they're also encouraging mergers between regional banks to try and build competitors that can actually stand up to giants like Chase.
So a wave of bank M&A could be coming.
That seems to be the plan.
Okay, let's bring all this together. We've covered a lot of ground. What does this all mean for someone just trying to navigate 2026?
Well, if we synthesize this, we're in a very unique spot. We have a market that is historically expensive. Remember that 224% Buffett indicator. But it's also completely bifurcated.
Right. We've got a silver supply shock driven by geopolitics. We've got a consumer struggling to buy toothpaste while at the same time throwing money at the stock market. And this massive rotation out of software and into the physical infrastructure for AI.
It's a market of very specific opportunities and very specific landmines.
Which leads us to our final thought. You mentioned the retail investor earlier.
I did.
And this is the thing I want everyone to really think about. We know from the data that institutions, the pros, they're selling into this strength. They're de-risking. The only group that is consistently buying the dip and propping up these prices is the retail investor.
The buy the dip generation.
Exactly. But here's the provocative question. If that soft landing doesn't happen, if we do hit a real recession and people start losing their jobs, that retail wall of money just disappears.
They run out of cash.
They run out of cash. And if that last buyer steps away from the market, who's left to hold prices up?
That is a very sobering thought to end on. If the last buyer leaves the room, the price has nowhere to go but down.
And if you want to keep an eye on that risk, don't forget to download the Buffett Indicator app from the App Store. Just watch that number.
It's the best way to stay grounded when things get this dizzying.
And for the full breakdown, all the charts, the deep dive reports, just head over to deepvalues.ai and join the club. We'll be tracking all of this as it unfolds.
It is going to be an interesting year.
Absolutely.